A mutual fund is an investment vehicle that pools money from numerous investors to purchase a diversified portfolio of securities, including stocks, bonds, and short-term debt instruments. These pooled investments are managed by professional fund managers who allocate the fund's assets to achieve specific investment objectives outlined in the fund's prospectus. This document provides detailed information about the fund's goals, strategies, and performance. The combined holdings of a mutual fund are referred to as its portfolio. Investors buy shares in mutual funds, representing their ownership stake in the fund and its underlying investments. This structure allows investors to gain exposure to a broad array of assets, benefiting from diversification and professional management. Units of a mutual fund function similarly to shares of a company. When a mutual fund raises capital, it does so by issuing units to investors, much like a company issues shares. In the context of mutual funds, these units typically have a face value of NPR 10 compared to the face value of NPR 100 for company shares. Each unit represents a proportional ownership in the fund's portfolio. An open-ended mutual fund is one that remains available for subscription throughout the year and is not listed on stock exchanges. Investors can buy or sell any part of their investment at any time, with transactions priced based on the fund's net asset value, or NAV. These funds do not have restrictions on the number of units they can issue, providing flexibility and liquidity to investors. Closed-ended mutual funds, in contrast, raise a fixed amount of capital through an initial public offering, or IPO, and then invest the proceeds in a diversified portfolio of assets. Unlike open-ended funds, closed-ended funds do not issue new shares after the IPO. These funds are typically listed on stock exchanges, allowing investors to buy and sell shares at market prices, which can fluctuate based on supply and demand. Closed-ended funds often have a fixed maturity period, at which point the fund's assets are liquidated and proceeds are distributed to shareholders. Differences between open-ended and closed-ended mutual funds. Understanding the differences between open-ended and closed-ended mutual funds can help investors choose the right type for their needs. Allow investors to purchase or redeem units based on the fund's NAV at any time. No fixed maturity period. Units are not listed on stock exchanges. Transactions are conducted through fund managers or distribution agents, suitable for short-term or long-term investment plans. Investors buy or sell units at market prices, which can differ from the NAV. Fixed maturity period. A fixed number of units issued until maturity. Units are listed on stock exchanges, and transactions occur through brokerage firms, suitable for specific period investment plans. Investment areas for mutual funds. Mutual funds can invest in various sectors, providing diverse opportunities for growth and income. Dividend declaration in mutual funds. Mutual funds typically declare dividends at the end of the fiscal year. These dividends are distributions of the fund's income, which can include interest income, dividends received from stocks, and realized capital gains. Investing in mutual funds is generally considered safer compared to investing directly in the stock market. This is because mutual funds offer diversification, spreading investments across a variety of securities, which helps mitigate risk. Additionally, professional fund managers are responsible for selecting and managing the fund's investments, further enhancing the potential for stable returns. The net asset value, or NAV, represents the underlying value of a mutual fund. It is calculated by the mutual fund company and indicates how much each investor would receive if the fund's portfolio were liquidated and all liabilities were paid off. The NAV is a critical metric for mutual fund investors, as it helps them gauge the fund's performance and value. The NAV per unit of a mutual fund is determined using the following formula. The NAV per unit equals the total assets minus the total liabilities, divided by the outstanding total number of units. This formula ensures that the NAV accurately reflects the value of the fund's assets minus any liabilities, divided by the total number of units outstanding. All right, let's talk about the role of mutual funds in the capital market. Mutual funds play several vital roles in the capital market. Firstly, they help in the mobilization of savings. Mutual funds gather savings from individual investors and channel them into productive investments. Secondly, they introduce new investment instruments. They offer new avenues for investment, providing options beyond traditional stocks and bonds. Next, they offer protection for small investors. Mutual funds provide a way for small investors to access diversified portfolios, which helps in reducing individual risk. Moreover, they give a boost to the capital market. By investing in various securities, mutual funds contribute to the liquidity and stability of the capital market. And finally, they promote transparency. Mutual funds enhance transparency in the securities market through regular reporting and adherence to regulatory standards. Now, let's move on to the maturity of mutual funds. As mutual funds approach their maturity date, they begin selling their assets, including stocks, bonds, and debentures. The total cash collected from these sales is then distributed among unit holders based on their holdings. This process ensures that investors receive their share of the fund's value upon maturity. Bull market and bear market. A bull market is characterized by a sustained rise in market prices, driven by positive investor sentiment and strong economic indicators. In a bull market, the prices of listed securities generally increase. Conversely, a bear market is marked by declining prices and negative investor sentiment. In this market, the prices of listed securities and market indices trend downward. Bonus shares versus stock splits. Bonus shares are additional shares distributed to shareholders from a company's profits. They enhance the company's creditworthiness without altering the face value of existing shares. Bonus shares increase the total number of shares, but do not change the ownership percentage of shareholders. A stock split increases the number of shares held by shareholders by splitting existing shares. It is typically done to make shares more affordable and enhance liquidity. The face value of shares decreases proportionally to the split ratio. Compensation for losses in stock investments. There is no provision for compensating investors for losses incurred while investing in stocks. Investors bear the full risk of their investments, including both profits and losses. Therefore, it is crucial for investors to perform due diligence and consider their risk tolerance before investing in the stock market. In conclusion, mutual funds provide a valuable investment vehicle for individuals seeking diversified exposure to various asset classes. By pooling resources and leveraging professional management, mutual funds offer a way to invest in a broad range of securities, reducing risk and enhancing potential returns. Whether opting for open-ended or closed-ended funds, investors can find mutual fund options that align with their financial goals and investment horizons.